Hey there, loan officers and realtors who I work with. This is Scott Groves with Synergy One Mortgage and Consolidated Coaching. And, normally we send out this monthly newsletter of like, hey, what am I thinking? What am I reading? What am I watching? Et cetera, et cetera, et cetera. And this month we thought we would send out this video here kind of explaining what I'm thinking. And I'm thinking a lot about this guy, Dave Ramsey, which I know that he is beloved in some circles and hated in some circles. And look, I don't agree with everything that he says as far as only doing a mortgage at 15 years. And, there's some people in America who can manage their debt well. But the reality is his core principles on getting and staying debt free, I think is probably the best financial advice for 80, 90, 95% of Americans. And with rates going up, but inventory still low, which is causing property values to stay high, we really have to assess or reassess where we're spending our time and who can actually afford to buy a house. Like, there's nothing I love more than helping a veteran or a first-time buyer get into a starter house, a condo, something that maybe is a little bit of a stretch for them. But hey, they're paying $2,600 a month in rent, because I mostly service areas like Los Angeles, Las Vegas, Austin, Texas, where things are not cheap for rent. So they're paying, $2,600, $2,700, $3,000 a month in rent, $4,000 a month in rent. And when the all-in cost of home ownership was $4,000 a month, you could kind of bridge that gap and explain, hey, here's the tax write-off, here's the benefit of being a homeowner. But now with that gap being, all right, I'm paying $2,800 a month right now for rent, but I'm going to be going to $5,000 a month for a mortgage. That's a much tougher pill to swallow. And I think a lot of us haven't realized how few people can actually afford to be homeowners in major metropolitan areas. So there's a tool that we're going to link to here in the newsletter that's on Freddie Mac. And I want to go through a couple of numbers with you to show what this might look like. And I'll do kind of a lower cost, more like rural area or low cost area. And then I'll show you what it would be for like an area like Los Angeles. So if we go to let me make sure I'm doing this correctly. If we go to the Freddie Mac home buying tool, and we scroll down here, it gives you some good information, right? So the average income, I looked up all these numbers before I started filming. The average number, household income in America is $74,580, right? And then if we take, okay, well, what is the average debt load look like in America? The average used car is running at a monthly payment of $526. The average new car payment is $716. And the average college loan payment is $284. So if we just take the lower end of this, right? Like, let's say you have a $500 car payment, right? Let's say you have a $280 student loan payment. And then the average payment to credit card debt in America right now is about $430. So you've got your average household, right? And obviously there's some people that follow this Dave Ramsey belief of being debt free, and that's awesome. And there's some people that are just drowning in debt. But the median in America is around $1,210 in monthly debt. And if you're thinking about yourself, if you're a realtor or a loan officer, and you're thinking like, oh yeah, I got that $600 car payment, I've got that credit card, I've let the balance grow, and maybe my student loans have been in deferment for a couple of years because of COVID, but I got a couple of student loans. That's a reality, right? And then if we put in here a down payment, let's say if you're making $75,000 a year, maybe you've been super diligent, you saved your pennies, you got some gift funds from grandma, and you can put $75,000 down, right? And then we go into some other assumptions here. Term interest rates, not uncommon to see an interest rate around 7%. So if we think about taxes in California, they're about 1.25%. So let's say your annual property taxes about $3,500 a year. Homeowners insurance is getting more and more expensive nationwide. For a lower cost property, let's say maybe $1,500 a year. I think that's being a little generous. For the average household in America, this backs them into a $250,000 home that they could get approved for. The average household in America based on average income, average debt. Now, let's look at some of my, traditional Los Angelino buyers, right? Tends to be a single man or a single woman or a family just starting out. And let's say they are significantly exceeding the statistic. I also looked this up, and in Los Angeles County, the average income for a household in Los Angeles County is about $116,482. That's what I pulled up from Google. And let's say you're overshooting that, right? So let's say you're making 20% more than the household average in Los Angeles County, and you're making 135,000, right? Well, chances are if you're making 135,000, you might have a slightly nicer car, you might have a slightly nicer degree from a more established college or more prominent college that costs you a little bit more, but I'm going to leave the debt the same, right? So you're excelling by a significant amount. You're exceeding by a significant amount what your average income would be either nationwide or even in Los Angeles County, but we'll keep the debt right around where the average household debt is, right? Let's say because you're making more money, because you maybe come from a more affluent family, let's say you have a much bigger down payment, right? You've saved more than 1 times your annual income towards the down payment. And now if we're thinking property taxes on a $600,000, $700,000, $800,000 house at 1.25%, you're going to be around $7,500. Homeowners insurance is going to be closer to $2,500. And let's say the only thing you can find in Los Angeles is a HOA or a townhouse or living in a planned urban development or somewhere, in the suburbs like Valencia, where almost all the housing tracts have some type of HOA. So let's say, $112, I think is what I paid on my HOA in Valencia. This backs you into a $586,000 house is what you can afford. And think about this. I'm leaving the monthly debt payments at the national average. I'm giving you an excessive amount of income, comparatively speaking, to what your debt load is and how much you've saved for your down payment. Well, the easy solution to there, go to Redfin, and let's just go to Los Feliz, California, which is an area that I have served for a long time. And let's put in all the filters. You can buy up to about a $590,000 house. And let's say you're willing to do a house, a townhome, or a condo. And let's remove the outline. There's currently 1 house in your affordability range in Los Feliz. And if we start to back out, all right, there's a decent amount of houses here under $590,000. But what I tend to find when I talk to the person who's making $135,000 a year and they've saved their $150,000 down, they're thinking more along the lines of like, well, what I really want, Scott, is I need 3 bedrooms because I have a kid and I want a home office. And I'm going to be honest, man, like I don't want a townhouse or a condo, right? So let's go back in here. Let's remove the HOA dues. So we'll move that $112 a month in HOA dues. That will take them up to a payment of, or a purchase price of $603. So now we can put $603 in here. And we want a 2-bedroom, 2-bath house, or 3-bedroom, 2-bath house somewhere in Los Angeles. And this is basically showing, most of LA County. Yeah, now we get into Anaheim, that's Orange County. But most of LA County, there is 38 homes for sale. And how many homeowners are in Los Angeles County? There is currently 3.6 million units of housing in Southern California. So for this person, again, just working backwards, who makes $135,000 a year, hasn't gone crazy on their debt, right? Didn't go $250,000 into student loan debt, which I have a lot of clients who get in touch with me where this is the case. They're going to have a near impossible time buying in Southern California of, 3.6 million housing units around LA County. There's 38 for sale that might be under 600,000. And I can tell you from experience, a lot of people making that kind of money maybe don't want to either live in these areas or they don't want to do this much work on a house that needs to be fixed up. It's like the pool of available buyers based on the current interest rate has gotten significantly harder, right? And let's just shoot for the fences, right? And so the other day I was talking to a guy, he's a director for commercials. So he does car commercials and stuff. He makes about $500,000 in his corporation. But after expenses and whatnot, he nets about 265. He does have 2 car payments. Both he and his wife have a car. They do have some student loans. And they do have some credit cards. So they're around $2,600 a month in minimum payments away from their aside from their housing expense. And they got some gift funds from family and they've saved some good money. So they have about $225,000 down. Now we start looking at a million-ish house in Southern California, especially if you're up in the hills. Your taxes at 1.25% are going to be around $12,500. Your homeowner's insurance is going to be closer to $3,000. And now we kind of back into a purchase price of about 1.1 million. Okay, sounds awesome, right? But again, this particular individual wants to live and only live here in this Los Feliz area, Atwater, maybe Eagle Rock, maybe Glendale, right? So if we put these filters here at 1,000,001, and he has to have 3 bedrooms. He would like to have 2.5 or more baths because he wants one for him, one for his kids, and hopefully one for the home office. 3-bedroom, 2.5 bath at 1,000,001. There is not a single property available. Oh, I take that back. There is one condo or small unit development, right? And if you think about it, here's the person that's done all the right things. He's making 500 grand a year. He's netting after his tax write-offs, which he is absolutely appropriate in taking, 265. He's saved his 20% down. He doesn't have an excessive amount of debt, right? He has a Tesla payment and a Honda payment and some credit card debt and a student loan. There's, in the area he's looking in, there's one house under $1.1 million. And he's going to be looking at a mortgage payment of about $7,300. So my point in all of this is not to discourage the loan officers and the realtors that I work with, who I work with. The point is to show you, like, we need to be having serious conversations, loan officer to realtor, realtor to client, loan officer to client. We need to be having a serious conversation about, hey, this is what stuff costs right now. This idea, which I've been complaining about in the loan officer space for 2 years now, of like, oh, date the rate and marry the house. You'll be able to refinance no problem in a year. We don't know that that's true. I think it's going to be able to happen where you can refinance because all of this stuff is cyclical. But that's not a given. That's not an absolute certainty. And although I would like to think people that are getting an interest rate right now in the 7% range or the high 6% range could refinance somewhere in the 5s in the future. Again, we have to plan for what is today, not what might be in the future. And I want to be able to have these serious conversations with my realtors when they refer me somebody who's looking to spend, under $3,000 a month and they have $50,000 down. Well, unless they want to move to an hour outside of Los Angeles, or an hour outside of Las Vegas proper, or an hour out of, Austin downtown limits, they just need to continue to be renters. And for a lot of our clients who, when I pull their credit report, their debt is through the roof, like, I'm just sending them many of them a copy of this book and be like, hey man, you're not available, you're not eligible right now to buy a house with your income, your debt, your down payment where you want to be. So let me know if there's a suburb where you can buy up to X, right? Which is your limit, either on monthly payment or total approvability. Or let me send you a copy of this book so you can get your finances in a better shape so we can try again in 6 months or 12 months. And these are kind of the things that I've been thinking, the things that I've been rereading, the things I've been watching, is just, regardless of what you believe, nationwide, socioeconomic, political, the reality is student loan debt, the highest it's ever been, and those payments kick back in October. The COVID forbearance relief ends, and people are going to have to start making their student loan payments again. Car debt on car loans, highest it's ever been in American history. Credit card debt, credit card monthly payments, highest it's ever been in American history. And now we look at interest rates, the highest they've been in about a decade, and property values, the highest that they have been ever in the history of America. Just something has to give, or we have to accept the fact that like most of the people we're talking to won't be able to afford to buy a house. And so we just need to talk to a bigger, wealthier pool of people who can become potential buyers so that we can stay in business. And that's just the reality of the situation. Sorry to be a downer in this month's newsletter, but I think this is important stuff that we have to understand as a industry in real estate and mortgage. If you need help, right? If you need help talking to your clients about this stuff, if you want to have a conversation, if we're a realtor that we work together, or you're a loan officer looking for some coaching, let's get in touch. Let's talk. All right. Love you lots. Talk soon.